Buy the home now, save some money for closing costs when you refi the mortgage. Call it in. It's not about the rate, it's about the home. You love the home? Yes, buy the home. You know that there's going to be 5, 15, 20 bids on a property that you love, and you've been seeking out an offer to make on that property, but you can't because you're not prepared. Being prepared is the best way to really get something accepted in this market.
A lot of my clients are paying cash for their properties, and they always ask me how easy it is for them to put a mortgage on those properties later on. So there are multiple terms for this. It's cash out, cash back refinancing, correct? Tell us a little bit more about what that process is like.
So doing a cash out refinance, like you said, there's so many ways to say it. There's like cash out, cash back, delayed financing. It's all the same. It's all saying that, hey, I need money for my home. Is that possible? The answer is yes. So let's say in New York, it's primarily co-ops and condos. If you bought $1 million place, that's a co-op for, an all cash. If you want to borrow, 70, 80% of it, a lot of people should do that, right? So I always say that the average appreciation in New York is about 4%, right?
Yeah. You can only borrow a certain percentage of the value of the house or the equity that you have. Explain that a little bit more.
So it really depends, right? So depending on how much money you want to borrow, right? If it's $1 million home and you want 50% of that back, right? So if you borrow above 80%, you have mortgage insurance, right? So if you don't want to incur mortgage insurance, you have to borrow less than 80%. So if you borrow 80% versus 70 versus 60 versus 50, your interest rates do change. So a lot of the times customers will borrow 50 to 60% of it because they get the best interest rates. For example, let's say you borrow a loan amount of $900,000 against like a $1.5 million co-op or condo, you're going to get really good interest, right? Because it's a jumbo loan. You're coming to a bank, you're getting a wealth relationship, and you're getting good base pricing. So for example, I have clients that are borrowing $900,000 from the value of their home, getting rates below 5.5%.
Right.
So if you have clients that are still looking to get a cash out and they don't know of all these features, these are things that might be.
So with delayed financing, can people just get the money and do whatever they want with it, or do you have limitations?
So a lot of the time it's your own money, right? You're borrowing from the home, right? So that means you can borrow to invest in the market, to pay for your kids' tuition, to pay for anything, right? It's your own funds. So don't think that the bank is restricting you to use those funds that are yours, right? So make sure that those are all things that you can invest in, right? So a lot of the times people are going to take their money out of their home and, like I said, pay for a tuition, invest in the market, do home improvements, buy new furniture, right? Or even buy other properties, right? So that's the biggest thing.
That's a really good point.
So a lot of people will do delayed financing and use those proceeds to essentially, buy other properties. But there's also one more thing we can talk about, which is a line of credit, right? So instead of doing a cash out refinance on the home, you can get a line of credit. It's like getting, you can be approved up anywhere from $1 million to $100,000.
But do they have to have equity in the home? I don't understand how that works.
When you are doing
a line of credit,
so if you have a home that's $1 million and you only need $100,000 to use on the home, those have more restrictions on it for what you can use for. Depends on what you're looking to do, right? Do you want the funds to invest in the market? Do you want the funds to do home improvements? Do you want to redo your kitchen? Then getting a line of credit is easier because it's like if you don't use the funds, you don't make a payment, right? So you might be approved for $100,000 on the line of credit, but it doesn't mean you have to use those proceeds. You can just have it sitting. It's open and you can draw from it. It's like a credit card, right? So it's like having a credit card. It's there if you need to use it, but you don't have to pay for anything if you don't use it. The line of credit has a higher interest rate. And so any investment property, whether it's for a line of credit or a generic home, right? I would say line of credits are anywhere between today 7 to 8%, right? So you're paying a premium to borrow money like a credit card. So it makes sense to do a line of credit on an investment property if the rate makes sense. Closing costs are all similar. I would say for a single family home, it's 2 to 4%. For a co-op, it's 1 to 3%. So it all depends on the break even, right? Hey, does it make sense to pay $30,000 in closing costs and it takes me 24 to 36 months to refinance? It doesn't make sense.
So how much higher are the rates for an investor than a primary owner?
If you're getting a loan for $1 million, for example, right? For a primary residence, it's going to be anywhere from, base rate on a 7-year home is 5.75. When you're going to a second home, it can be anywhere over, it can be 6%, 6.25. But investment properties are definitely over 6.5. The problem with investment properties today is that your overhead is not enough to cover your cost, right? So only till you can get rates below 5.5% over the next few years, you'll see more investment property purchases, right?
New buyers or potential buyers, I should say, are wondering, should I continue to rent or should I own? And it's a very interesting question. And you have been great at handling it with a lot of our clients.
So it comes down to your flexibility, right? So when it comes to renting versus buying, if you're renting an apartment for $4,000, you're most likely going to incur a mortgage that's inclusive of taxes, insurance, common charges, close to $7,000 to $8,000, right? If you're a first-time home buyer and you want to get into a place and you feel like you need help, most people need help, right? The average age of a first-time home buyer is 38 to 40 years old.
And that's crazy to me.
Like, I would say you need at least $200,000 in income to even live in New York, and even still you're paycheck to paycheck.
We have buyers in all price ranges, but even buyers in the $2.5 million price range don't feel like they can afford what they want. It's crazy.
And it's hard, right? Like, our job is to validate something, say, hey, we want to get into this home, but we don't know if we can afford it. When you work with a partner like me, that kind of uncovers what they're stressed about, because real estate is an emotional purchase, right? So my job is to guide someone to feeling like they can afford something, not forcing them to a product or forcing them to get a 30-year fix.
That's what builds trust.
Yeah.
At the end of the day, you're there for them to explain the process, but not pushing them either way.
And again, there's a million loan officers, a million realtors that go to, but why would they choose us, right? It's because we hold their hand, make them feel like confident themselves. They feel like, hey, I have a team that's going to support me.
I had a client who went online, got approved for a mortgage. She had a 1-800 number.
Yeah.
And I kept saying, have you actually talked to anyone? Because we need to know that you are going to be able to be pre-approved. And it was so dreadful to deal with this online company. So now this was years ago. Now I'm like, okay, we're going to work with a real person.
Yeah. I have customers calling me saying, hey, I'm starting a new job. Will that affect my mortgage? Absolutely. Like, I have a client now that just got an accepted offer, yesterday. And she's like, hey, I'm starting a new job. It's 1099. I'm a contractor.
Oh,
and I'm like, hey, we can't use your income.
That's tough.
Good thing your husband has enough income to support your purchase, right? And so they're buying a condop, which is treated like a co-op purchase in New York, which has less closing costs between $10,000 to $15,000.
Oh, it does? I didn't know that.
So because the bank treats it like a co-op, you have less. Your closing costs are not as expensive. Where a resale condo is 3 to 4 or 5%, where you can still getting $1 million co-op for $10,000, $15,000 post-closing costs. It's more feasible, right, for a first-time home buyer to go into a co-op.
What's the time frame?
So I would say for a co-op, we give you a 90-day rate lock, so you have 60 to 90 days. The biggest problem is getting the building approved and getting the buyer through the board package. If you're buying a co-op on Fifth Ave, they're going to take their time.
Oh, yeah. What is the biggest mistake that a lot of your clients make or some of your clients make?
I would say the biggest mistake is thinking you can qualify for more than you actually can. A lot of people will go out, look for real estate, and then qualify and not know the numbers and realize they don't qualify.
And then this is why I ask all my buyers to show me their pre-qualification letter or pre-approval letter if they went that far. Because a lot of the times they're thinking, I'm going to do a 30% down or a 40% down loan.
Yeah.
Then I look at the numbers, especially if they're buying a co-op, and it's taking away a lot of their post-purchase liquidity. So I tell them, I said, no, you can only put down 20% or 25% because we need to show more when we submit the board package. So I think that's a mistake that a lot of new homeowners make too. It's not discussing their down payment with their real estate agent.
Oh, for sure.
You know what? I've been wanting to ask this question. If I have credit card debt, but I pay it, let's say on a monthly basis, how do you guys handle that?
It's all about showing on-time payment. But the only reason it affects you, to go back to what we talked about before about co-ops and their DTI restriction, debt to income ratio, we will add the monthly payment of that liability, credit card, whatever it is, to your monthly payment, right? So if you're going to a co-op and you have a 28% debt to income ratio and you have a high monthly payment on credit card, that's going to hurt your qualification. So being able to pay off your credit cards, student loans, auto debt is the best way to get, you have more flexibility.
So this morning I received a call from a brand new buyer and he said, my dad's going to give me $100K so that I can pay my student loans, my credit card debt, and whatever else. How do you guys view these type of gifts? Does she have to tell you about these gifts, or how does that work?
The way it works is that, hey, let's say the dad gives the daughter $100,000. She'll receive that into, for example, her, Chase, Wells Fargo bank statement, and then, she'll pay off the credit card or whatever debt. What will happen during the mortgage process is that we'll see that transaction happen, and then we would need to basically get a gift letter, or we'll need to qualify that payment or just understand where it came from. But that's really it. Getting a gift in today's market is the only way for a person that's
A lot of the young
30 to 40 years. Like, you need either a parent, you need a co-signer, you need a friend or a family member to help you buy real estate.
And you don't think the rates are going to come down anytime soon?
I think that over the next year, we'll see rates come down a little bit, but unfortunately, the economy and inflation is still sticky. There are geopolitical problems in this world that are still affecting interest rates. But at the end of the day, it's not about the interest rate. It's about buying a home, guys. Like, who cares about the interest rate? You can always refinance.
Delay refinance.
Yes, exactly. So if you can afford the monthly payment today at a 30 or fixed at 6%, buy the home now, call it in. I want to start purchasing real estate so I can build,
Are you going to call me?
Yes, of course. It's like, I want to start buying real estate and investing and start buying, because over the next 20 years, that's where the money's going to come from. So we are here to facilitate the process of getting a home in New York, because it's really difficult. Having the right partners is the most important, and we have both of us.
Thank you for watching. Please like, share, and subscribe for more real estate tips.